U.S. stocks, they continue to rise Tuesday afternoon following yesterday's massive rally. To talk about today's rise, yesterday's rally, as well as tomorrow's expectations, standing with me as always, I have Peter Cardillo, Chief Market Economist for Rockwell Global Capital. Mr. Cardillo, pleasure to see you today. How are you?
Be back.
All right, I have to ask you about a little bit about today's rally, today's rise and yesterday's rally. Now, stocks, they continue to rise this morning because of yesterday's surge that was led by Larry Summers unexpectedly pulling out of the race to become the next Fed president. Now, what's your take on him pulling away, as well as what do you think that means for the Fed in the future?
Well, look, it was a bit of a surprise that he did pull out of the candidacy, but I think that obviously that puts us into the camp for Mrs. Yellen now, and of course it would be rather historic because she would be the first female to head the chair at the central bank. But nevertheless, she is depicted as a dovish Fed member, and she's quite liberal and aggressive when it comes to easy monetary policy. But again, I think sometimes it's probably a mistake to really label people, especially Fed members, under those categories, simply because of the fact that I think we've had ultra liberal monetary policy over the past 4 or 5 years, and that's simply because of the fact that the situation at that time warranted. Mr. Bernanke certainly was extremely aggressive, and he had to be. We can say thank you, Mr. Bernanke, because he basically saved the economy from falling into a deep recession. So I think it goes down to the fact that whoever is picked as the next chairman is going to have to weigh the present economic situation and certainly take into consideration what's happening around the globe, especially the emerging markets. Now, there are some good signs coming out of India, but we're still very much concerned about the emerging markets. And so I think that, the next head of the Fed is going to look at the whole picture and not just the domestic economy.
Let's shift focus a little bit to today, more specifically today's economic data. We had homebuilder sentiment remaining unchanged, which was expected to slightly rise. We also had consumer prices ticking higher, but short of expectations. With that sort of data, can you explain why the markets are even just a slight bit higher today?
Yeah, to be honest with you, I was looking for a range-bound market, something that would probably be flat to a little bit higher or perhaps a little bit lower, and yet we see the averages ticking up a bit. I kind of suspect it's probably because the economic data wasn't all that disappointing. The Consumers Price Index actually came in slightly higher. Slightly lower than expected, but the key is that inflation remains quite subdued, and that obviously is going to be taken into consideration by the Feds, which are now discussing Fed policy and formulating their economic forecast. As far as home builders index is concerned, I was a little bit disappointed. I thought we would tick up a bit, and that brings us back to something that's very important here. If you look at some of the housing indicators, we see especially the MBA applications continuing to decline, and that's because of the recent hike that we had in yields. And so the Fed is going to take that into consideration, and that's why I guess, even though I'm going to be wrong about this, that I think the Fed might actually surprise the street and stay on hold. If they don't, obviously it's going to be a mild tapering, somewhere between 10 and 15 billion, which is already priced in the stock market.
Well, you just mentioned it slightly, but we have to address that of what's the biggest concern amongst investors and analysts all alike is the Fed tomorrow, the FOMC meeting. They are expected, as you said, to taper. Investors, analysts are expecting it as well. I just have to ask you, do you think it's a bit premature, and do you really expect it? You kind of answered that already, but again.
Yeah, I think it's premature because I think some of the economic numbers, especially the housing, are beginning to indicate that the hike that we had in yields is beginning to take a bite. But more of a problem, I think, is the emerging markets. Again, we go back to India. So I think it is premature, but obviously, you know, the Fed's rhetoric suggests that they will. Again, it'll be a token reduction in the bond buying program when they do announce it tomorrow. But could we get a surprise? I think so. You know, I've been saying this week after week that I think they're going to stay on hold. Again, I'm going to be wrong about it, but there is that chance. Now, would that, what does all of this mean for the markets? Well, I think if they come out and do what the market is expecting, probably a non-event. If they do come out and say, no, we're going to give it one more month, we want more evidence, and perhaps maybe taper off in December, begin tapering in December, then I think we could expect the market to actually have in a very strong session in the latter part of tomorrow's session.
Mr. Cardillo, as always, thank you for your insight.
My pleasure.